Welcome back, everyone. I'm Fertilizer, investment analyst with over a decade of experience. Here we connect the dots between macro, crypto, and AI. No noise, just what actually matters for your portfolio. 3 things today. First, March inflation. The first print we have since the Iran war, and it's saying more than the headlines suggest. Second, I pulled together 70 years of data on what actually happens to asset prices when real rates go negative. And third, what AI is doing to the market right now. Software breaking on one hand, the grid running out of capacity on the other. Quick disclaimer, nothing on this channel is financial advice. I'm sharing my views and analysis, but always do your own research before making any investment decisions.
This video was created in collaboration with the IT company Anderson.
Let me start with a quick update on the situation in the Middle East, because a lot has changed since last week. When we recorded the last episode, the US and Iran had just agreed to a 2-week ceasefire. Oil dropped 15% in a day, equities rallied. The mood was that the worst was behind us. That lasted about 24 hours. Iran said the ceasefire was violated on the first day. The Strait of Hormuz was technically reopened, but the traffic barely recovered. Then came the Islamabad talks. After 21 hours, the talks collapsed. Zero deal. The nuclear program was the wall. And then on Sunday, Trump announced a US naval blockade of all Iranian ports. Not sanctions, a physical naval blockade. The US Navy will interdict any vessel that paid Iran's Hormuz toll. Oil is still at around $90 to $100, and as of Wednesday, it looks like Iran is eager to continue the discussions. And equity markets are already back to the pre-war levels, which is quite impressive. However, if oil stays at this level, chances of global recession, especially in energy-importing nations, are rising. So, with this backdrop, let's go back to the inflation print, the first data point we have with war impact. Let's start with the numbers. The March CPI came in at 3.3% year over year on the headline, the highest level since May 2024. The month-over-month print was 0.9, which is a big number. However, core inflation, which is inflation without the direct impact of energy and food, was 2.6. But as always, the devil is in the details. Let's look at what is happening underneath. Gasoline was the main driver. No surprise. It surged 21% in a single month. That is the largest monthly increase since the Bureau of Labor Statistics started publishing the series in 1967. It drove 3/4 of the headline move. But it's not only about gasoline. Airline fares were up almost 3% month over month. Jet fuel is crude derived, so that moves fast within 2 to 4 weeks. Both are first-order effects from oil filtering into real economy. And the second-order effects have not even arrived yet. Fertilizer prices have gone vertical. Diesel just had its biggest move in 25 years. China banned the sulfuric acids exports, which is a key input for both fertilizers and copper processing. Food inflation is in the pipeline. It takes about 2 to 3 months to show up at the grocery store. So the worst of the pass-through is still ahead of us. And as I mentioned, oil prices are not going lower regardless of what the headlines say. But the number the Fed actually looks at is not CPI, it is core PCE. The weighting is different. I will not get too technical. What matters is that the Fed is looking at PCE. And core PCE came in at 3.1% year over year. And again, this is core inflation. No direct oil or gas impact yet. That is already materially above the Fed's 2% target. And the year-over-year number is smoothed by older data. The monthly prints tell a sharper story. Core PCE has run above 0.3% month-over-month for 3 consecutive months, with February hitting almost 0.4. That has only happened twice in the last 25 years. The other time was during the 2022 inflation peak. And that is why the recent pace matters so much. If the last 3 months kept up for a full year, inflation would be running at 4.4%. Zoom out to 6 months and it closes to 3.4%. The recent months are running a full point hotter than the broader trend. Core PC is not cooling, it is getting worse. And here's where it gets interesting. The minutes from the Fed's March meeting came out last week. They read much softer than the public statements have been. The Fed is more worried about the economy than they're admitting publicly. Here is a direct quote from the minutes. The vast majority of participants judged that upside risk to inflation and downside risk to employment were elevated. Both, not just inflation, employment too. Multiple participants flagged that a protracted conflict in the Middle East would hurt household purchasing power and soften the labor market. Most said it was too early to assess the full economic impact. So, read that again. The Fed sees inflation rising because of oil, but it also worried that the oil shock is going to cost jobs. And when the Fed has to pick between fighting inflation and protecting the labor market, history says, and the minutes imply, they pick the labor market. So, if anything, the base case is that they cut into or hold into rising inflation, not the other way around. And then there is the May transition. Powell's term as Fed chair ends next month. And here is the key point. Trump has been publicly advocating for much lower rates for a long time. He had an open, public conflict with Powell over it. Now, Trump gets to pick Powell's replacement. The nominee is Kevin Warsh. But the point is not really about Warsh. The point is that whoever Trump picks is going to be biased towards cuts, because that is what Trump wants. So the direction of the Fed is about to shift, and it is shifting dovish right as inflation is accelerating, even if temporarily. So let me pull all of this together. CPI is at 3.3%. The Fed funds rate is at 3.6%. The gap is 30 basis points. One more hot CPI print and we cross over into negative real rates. With oil holding at $100, the next 1 or 2 prints should do it. So the crossover looks likely. The real question is what happens when we get there. So everything we just covered points to the same conclusion. Negative real rates are probably coming. And I want you to know what that setup has actually meant for asset prices in history. So I went through the data back to 1955. Every time CPI crossed above the Fed funds rates, I looked at what happened next. It has happened 23 times. For the S&P 500, the 12 months return after the crossover was positive 78% of the time, 18 out of 23 events. The median return was about 6.8%, positive, but nothing spectacular. But one important caveat on equities. Those numbers are the average across all 23 episodes. There is a subset that matters much more for our current situation. The oil shock episodes, 1973 to 74 and 1979 to 81. In those, equities did not just underperform, they got hurt so badly during the drawdowns. S&P 500 lost more than half its value in real terms through the 1973-74 crash. And whether we end up in that kind of regime depends on one thing: how long oil stays elevated. If oil drops from here and the conflict gets resolved in the next few weeks, let's say, we probably do not get that. But if oil stays at $100 or higher for months, the risks are real. Rising inflation, slowing growth, a Fed caught between jobs and prices, that mix, oil-driven stagflation, is historically one of the worst environments for equities. We talked a lot about this in the previous episodes. Now, gold is the exact opposite. In the regimes where equities got hurt the worst, gold did its best. Since 1971, it has been positive in roughly 3 out of 4 crossover events. Median 12 months return of about 16%, more than double the S&P 500. In the 1971 and 1980s oil shocks, it returned 30 to 50% in just a few months. And then Bitcoin. Only 3 crossover events in its history, so the sample is small, but all 3 more than doubled in 12 months. Median return around 160%. And these regimes do not last a few weeks. Once real rates turn negative, they tend to stay negative for years. The first oil shock regime lasted 37 months. The Greenspan easing period lasted 31 months. The post-COVID regime lasted 42 months. You're not trading a 1-month event. You are positioning for a regime. The takeaway from 70 years of data is simple. When real rates go negative, hard assets do the heavy lifting. Gold has been consistent. Bitcoin has been explosive. Equities work over time, but the short term is bumpy, especially in oil shock regimes. That is the macro setup. And the macro regime is only half the story. The other half is what AI is doing to the market. As we have been discussing on this channel, AI is pulling asset prices in 2 opposite directions at the same time. It is destroying value in things that are abundant, and it's driving up the value of things that are scarce. Let's start with software. Software stocks continue to break down. The IGV software ETF, which tracks software companies, is making new lows. No bounce. The broader market had its best weekly rally since November last week, up 3.6%. Software did not participate. It kept falling. We talked about Mythos last week, Anthropic's unreleased model, the one they're holding back because it's too capable, not just the trading code, but on the cyber offense side too. That is the catalyst the software sector is pricing in. If AI can write, debug, and deploy code autonomously at 78% accuracy on real engineering tasks, the value of software subscription changes. Bitcoin is doing the opposite. It is not rallying, but it's not breaking down either. It is consolidating in a range between 67,000 and 74,000, while software collapses around it. In a single week, Bitcoin outperforms software by 22%. That is the largest divergence in 2 years. And why I bring this up is because since October 2025, they have been falling together. Right now, we see first signs of decoupling, which I believe is worth monitoring. Our thesis is that Bitcoin should be repriced as something different, not a tech asset, not a risky asset in a traditional sense, a scarcity asset. Code with the fixed supply that AI cannot replicate, cannot compress, and cannot disrupt. I'm still careful here with the conclusions as we only see first signs of the market moving in that direction. And this brings me to the other side of the scarcity trade, energy. We touched on this last week, but I wanted to expand the story. Last time I mentioned that training a new AI model requires a lot of energy. True, but what requires even more energy is inference. Every time you ask Claude a question, every time an AI agent runs a task, every time a company processes data through a model, that is inference. And it runs 24 hours a day, 7 days a week. It does not stop. In total AI compute energy, inference already accounts for about half today, and it's on track to reach 2/3 by year end. Here's the thing. The cost per token has collapsed. The price of GPT 3.5 level performance dropped 280 times between late 22 and late 24. Massive efficiency gains. You would expect that to reduce AI's total energy footprint. It has not. 2 things are happening on top of those efficiency gains. First, new models are more complex and use more energy per query. GPT-5 uses 8.5 times more energy per query than GPT-4. Second, total usage is exploding. Jensen Huang said that inference compute demand is running 100 times higher than NVIDIA thought they would need this time last year. And Alphabet disclosed on its Q2 earnings call that Gemini processed 480 trillion tokens in a single month, up from 10 trillion a year earlier. That is roughly 50 times growth in 12 months. This is Chavin's paradox. Efficiency is real, but complexity and usage are growing faster. Total energy demand keeps going up, not down. And here's the real problem. Every energy option is constrained. Nuclear is essentially maxed out. The existing fleet is running at 93 to 95% utilization rate. The 3 US restarts that are underway, the 3 Mile Island, Palisades, and the other one, are already contracted to hyperscalers. Building new nuclear takes about 14 years. Small modular reactors are not coming online before 2030. Nuclear is not saving us. Then there is gas. Natural gas is the only source that can deliver 24/7 baseload at scale. But gas turbines are sold out through 2030. GE Vernova's order book, for example, is heading toward 80 gigawatts by year-end. Orders stretching past 2029. If you order a turbine today, you do not get power until 2030 or later. So what is left is renewables. And yes, solar panels can be built in 1 to 2 years. That is fast. But solar and wind cannot do 24/7 baseload on their own. You need battery storage to bridge the hours when the sun is not shining. Renewables work, but only with a massive storage build-out. So energy is the squeeze point. You can't buy it, can't build it fast enough, and the demand is only accelerating. That is why energy infrastructure is one of the strongest structural traits in this market. To wrap up, the headline CPI looks tame, but core PCE is accelerating. The Fed is more worried about jobs than inflation, and the new Fed chair is coming in May, picked by a president who wants cuts. We are probably one print away from negative real rates. And 70 years of data says the same thing every time this happens. Hard assets do the heavy lifting. Gold stays consistent. Bitcoin goes explosive. Equities work over time, but short-term is bumpy. And AI is making this even sharper. Abundant things are falling. Software, code, services. Scarce things are holding. Energy, compute, Bitcoin. The regime shift is forming in real time. Long scarcity, short abundance. Thanks for watching. If this was useful, subscribe and share. I will see you next week.